Hello everyone, welcome again. In this lecture, we are going to start chapter number 17 of ACCA F6 Taxation, which is on the self-assessment for the individuals. So, the payment dates, if there are any penalties, and how many payments we have to make, and stuff like that. All right. So we will quickly go through the notes, and I will share the screen with you so that we can study the notes together. There isn't much stuff in this chapter which where you will need my help, because it is just a self-study chapter. Most of the classes, I just ask my students to just go through this chapter themselves, because there is nothing which can't be done without the tutor's help, really. So most of the stuff is the self-study, but I will just quickly go through the stuff, so we won't spend much time reading this chapter. However, this chapter is very, very important as far as the exam is concerned, especially in MCQ section, because it is a theoretical chapter, and this chapter is only theory, and another chapter which is on the company's self-assessment, that is also on the theory only. So these two chapters are only ones which consist on the theory, so they are very, very important from the exam point of view, especially in the MCQs question. If you come to page number 44 of your F6 notes, it is chapter number 17, and its name is basically self-assessment. So keeping the records, for individuals it is a different period. So if you are an individual and you do not have any business, so you are working for someone. So for example, if I'm working for Account Institute, I must keep my payslip. I must keep my payslips for 1 year period. However, if I am doing a business, then this period will be extended to 5 years. So if I am a business, I will have to keep the records for 5 years, and whereas if I am an individual, I just have to keep the records for 1 year. Now, what if I am an individual and I am an employee? Then what sort of record will I have to keep? I have to keep my pay slips, and I have to keep my records of any tax paid, my the year-end form P45, P60 if I left any job, and stuff like that. So these are the stuff which I have to keep record of, so that whenever HMRC asks anything out of that, I must be able to show them to HMRC, right? And as a businessman, you must have to keep the records of your invoices, your purchases, and stuff like that. So, because there are lots of stuff in the businesses. So for businesses, it is 5 years. And for employees, it is 1 year. However, when it comes to business and you have incorporated your business as a company, then this period will be extended to 6 years, and same applies to the VAT records as well. VAT records is also 6 years, but we are on individuals now. When we will move to companies, and when we move to our last topic, which is value tax, then we will study that as well. So for companies and value tax, its record keeping is 6 years. For individuals, it's 1 year, and for businesses like partnership business or a sole trade business, it's 5 years. Right? Now, if you've done a mistake in your tax return, and then you after doing the mistake, you have submitted your VAT return, and then you realize that you have done a mistake, then you can still amend your VAT return by changing the figures, and that can be done within the 12 months period, right? So that is a correction and amendment, and 12 months period after the filing date on which you have filed the return. Right, now after that it says compliance check on returns. Now, Officer of HM Revenue and Custom, if he suspects anything, then he might issue you a notice that he want to see your business. So that is called compliance check on returns. An Officer of Revenue and Custom has a limited period within which to commence compliance check on a return or amendment. The officer must give written notice of his intention by if the return is filed within the due date, then by 12 months after the actual tax return filing date, So if you have submitted the return on time, then he has got 12 months period. And if you have submitted the return late, then it will be quarter day, which will be every quarter of the year, which is 30th of April, 31st of July, October, and 31st of January, after the anniversary of actual tax return filing date. So he has 1 year, so he can, he will have to issue you, he will have to inform you first, then he can start the compliance check. A compliance check may be made if there is a suspicion that the tax has been incorrectly calculated. Compliance check may also be selected at random for an audit. So for example, even if the HMRC does not suspect you, even if they do not suspect, still they can come to your office and for an audit, because every year they select random people, so then they go to them and visit them and check the records for audit purposes. In the course of his compliance check, the officer may require the taxpayer to produce documents, accounts, or any other information if he requires. We already know about tax evasion and tax avoidance anyway. We have seen it in the first chapter. Tax evasion is illegal and tax avoidance is a legal way to minimize tax in the UK, and anywhere. The term is exactly the same. There is ethical conduct by the tax agent. If you as an accountant are representing someone, you are not only accountant, you are tax advisor as well. So after qualifying ACCA, you might be working for someone as a tax advisor, or if you have accountancy practice, someone comes to your office and he asks that could you please represent us as a tax advisor for our company for a 3 months assignment or something like that. And if your client is playing up with the rules and you came to know that they are not showing all the information to HMRC, or they are trying to hide the information, or they are doing money laundering or something like that, then you as a tax advisor and you as a qualified accountant has a responsibility. You must tell them the consequences. You must tell them not to do that. If they agree, that's fine. If they do not agree, just tell them the consequences, what would be the consequences, and tell them then that if they do not want, if they kept doing that, then you won't, as an accountant, you won't be able to represent them. And if they still do not stop, then you must stop acting for them as their tax advisor, and you must tell them you must tell the HMRC that you are no longer representing that client. However, you should not tell the reasons about that unless it's about money laundering or something like that. All right. However, if HMRC found that you are involved in money laundering, or you are involved in helping the client avoid the tax in an illegal way, then the maximum penalty could be up to £50,000. Right? On page number 45, it says discovery assessments. If an officer of Revenue and Custom discovers that the income or profits have been omitted from assessment, like an assessment has become insufficient or that the relief is given in excess, an assessment may be raised to recover the tax lost. Basically, it is exactly the same thing which we have seen earlier as well. So basically, HMRC officer, if he thinks that if he has a suspicion on you that you have been hiding the tax, you have been saving the tax in an illegal way, or you have been claiming too much relief and something like that, then he may start the discovery assessment. The normal limit for discovery assessment is 4 years. However, it can be extended to up to 20 years in more complicated cases where the tax is lost due to the deliberate understatement. Right, after that it says a notification of liability to income tax and CGT. Now, as an individual, you must tell the HMRC whenever you have any new source of income. So you must tell HMRC. Individuals who are chargeable to income tax or CGT shall receive a notice to file a return from HMRC. So you will receive a notice to file a return from HMRC every year. If you do not, however, if you do not receive any notice to file a return, then you must not keep silent. You must tell HMRC that I haven't received that notice, please send me that notice. Then HMRC will send you that notice After that, you can submit the VAT return, and then after submission of the VAT return, you can pay the tax liability. Now, you might be thinking the tax return and tax payment is the same thing. It's not the same thing. A tax return is basically a form which you have to fill, where you will be writing your sources of income and the tax rates and different allowances if you have claimed. So it will be detail of your tax calculation, and which you have to submit to HMRC. After submission of that information, then you will have to pay the liability which is calculated, right? So individual who are chargeable to income tax or capital gains tax shall receive a notice to file a return from HMRC. An individual who does not receive a notice to file a return are required to give notice of chargeability to an officer of Revenue and Customs within 6 months from the end of tax year, which is 5th of October 2017 for our current tax year. Submission of tax return, after that it says, now tax return can be submitted in two different ways. You can fill the form and fill the tax return and send it through the post, or you can do it electronically as well. Now if you send it by post, the date is earlier, which is 31st of October, whereas if you send it by computer electronically, the date is 31st of July. However, you can send both of these late as well if you have received the notice to chargeability later. Say for example, if you have received the notice to chargeability in in October, right, on 1st of October, then you will have 3 months to submit the VAT return, by paper. Likewise, the electronic one will also be up to 3 months late. Now, as it says in the notes as well, the tax return comprises a tax form together with the supplementary pages for particular source of income. The return can be filed electronically or paper return, whichever you prefer. The time limit for submission of the paper return is the later of. Now it says later of. Now the normal date is basically 31st of October. However, you can submit later if you have received the notice of chargeability late. A later of 31st of October after the end of tax year, and 3 months after the notice to file the return. So when you have received the notice to file the return, say for example, if you received it in October, then you will have 3 months, and not 31st of October will not be the last date. Likewise for electronic one as well, normal date is 31st of July. However, if you have received the notice to file a return late in November or December or January, then you will have up to 3 months extra. So 3 months after the notice to file the return. A time limit for submission of electronic VAT return is, so we have already done that, sorry. Now penalties for late filing of tax return. Now if you have submitted the VAT return late up to 3 months, then it is a £100 penalty. The more late you are, the penalty will be increased. Likewise, a tax return is late more than 3 months, but up to 6 months, it is penalty is £100, which is fixed for 3 months. However, for extra 3 months, it is £10 per day between 3 and 6 months. So maximum penalty can go to £1,000 in this case. So if you are, say for example, if you have submitted the VAT return up to 6 months late, then the penalty will be £1,000. However, tax return is between 6 months and 12 months late, then penalty will be greater of 5% of the tax liability and £300. Right? So on page number 46, if the return is late by more than 12 months, now if your return is more than 12 months late, then HMRC will say that you are doing it deliberately, or you are omitting it, or what are you doing? Because you can be late, 3 months is fine, 6 months is fine, you are late by 12 months, so what's wrong with you? Now there are three different cases. One is careless. You have been careless, then the penalty will be 5% of the tax liability and £300, whichever is greater than that. Now if HMRC thinks that you have been deliberate but you are not concealing, you are doing it deliberately but you are not concealing. When HMRC asks you, you tell them the truth, so you are not concealing it, you are not hiding it. Right? Now in this case it will be a greater of 70% of the tax liability and £300. However, if HMRC thinks that you are not only doing it deliberately, you are not only doing it with intention, and you are hiding it as well, in that case the HMRC won't be happy and they will charge you 100% of tax liability and £300, whichever is greater. Now appeals can be made in two different ways. We have already seen in first chapter anyway. So normal cases are heard by the first tribunal. However, an appellate tribunal is also available there. So if you want to go there, you can go there. But this is special for the complex cases or big cases. Right? After that it says determination. Now if you haven't submitted the VAT return late, then what HMRC officer will do, they will find out, all right, okay, say for example, if I haven't submitted the return, all right, he will find out, he say, all right, okay, Mr. Faisal hasn't submitted the VAT return. Okay, that's fine, you haven't submitted, all right, you are trying to play up with HMRC, that's fine. Then he will ask his colleague to give him a tax return. Then his colleague will give him the tax return, that's tax return. He will write my name on that tax return, and he will write my sources of income, whatever he thinks is my source of income. So when HMRC officer is filling your tax return, whatever he thinks, so when he's filling your tax return, he can write, I don't know, £100,000 or £1 million, whatever he likes. So HMRC will fill the VAT return and then it will submit on your behalf to HMRC, which means that you will have to pay, I don't know, you might have to pay £100,000 in the tax liabilities. So in order to avoid that, you must have to submit the VAT return. If you do not submit the VAT return, then the HMRC might do the determination. In that case, if he do the determination, then the HMRC officer will be fulfilling your tax return and he will be filling whatever amount of source he thinks you are earning. He can write, it's up to him, right? So if he's a nice person, he can write down, I don't know, £5,000 or £10,000. If he's not happy, if he's not in a good mood, then he can write down £1 million, and then you will have to pay tax on that. If notice has been served on a taxpayer to submit a return, but the return is submitted by the due filing date, an officer of HMRC make a determination of the amount liable to income tax. There's a mistake in the notes. It's not. So a return is not submitted. Return is not submitted by the due filing date. Please make sure you rectify it. Then an officer of HMRC may make a determination of the amount liable to income tax in CGT. Such a determination must be made to the best of officer's information and belief, and it is then treated as if it was a self-assessment. This enables the officer to seek payment of tax, including payment on the account for the following year and the charge interest as well. The determination must be made within 4 years after the end of the relevant tax year. Repayment of overpaid and repayment supplement. Now if you have overpaid the tax, then HMRC will pay you some interest on that. However, interest is not much amount, it's just 0.5%. If you have submitted the return late, if you have underpaid, then the HMRC will charge interest at the rate of 3%. However, if you have overpaid, they will give you just 0.5%. Right then, so payment of income tax. So there are 3 payments made in the income tax. So 2 payments are made on account, and the 3rd payment is going to be the balancing payment. So basically 3 payments are made. Now what are the dates on these 3 payments? As you know, our tax year runs from 6th of April to 5th of April. So 6th of April for our current tax year, 6th of April 2016 to 5th of April 2017. Alright, so that is our current tax year. Now, first payment we have to make is on 31st of July, which is first payment on account, and it will be during the tax year. Now, for our current tax year, which is from 6th of April 2016 to 5th of April 2017, which one will be the date? 31st of January 2017. 31st of January 2017 is the first payment on account. Now the second payment on account will be 31st of July after the tax year, which will be 31st of July 2017. And the third payment is going to be 31st of January after the tax year, which is going to be the balancing payment. Alright? Now the balancing payment, and what are these payment on accounts? Now another question arises as well before we move to payment on account. and balancing payment, and in this question we will have the answer to the other question as well. So basically what happens is that our tax year is from 6th of April to 5th of April. But how can we know what is going to be our tax liabilities? Because we are going to pay on 31st of January. Our tax year is ending on 5th of April, but we are paying the tax liabilities before our year end, right? Our tax year is going to end in April. We are paying the tax liability first payment on account on 31st of January. So how are we paying? We are paying 50% of the tax liabilities of the previous year, right? HMRC thinks that you're earning whatever you're earning was in the previous year, so you have to pay the tax according to that this year. So first payment will be 50% of that, second payment will be also 50% of the previous tax liability, and the last payment will be the balancing payment. So balancing payment means that whatever your tax liabilities are for this tax year 2016-17 minus whatever you have already paid. So that is the balancing payment basically. Right? Now, as you can see on your screen, 31st of January in the tax year, first payment on account, 31st of July after the tax year, second payment on account, and the last payment is final balancing payment is 31st of January after the tax year. Right? Now, another interesting thing as well, if you see that the second, if you look at the second 31st of January, which is the balancing payment date. Now, if you know that on the balancing payment date, which is the 31st of January, we will be paying one payment will be the balancing payment, and another payment as well, which we will be making is payment on account for the next year, right? I hope that you would appreciate the fact. We are looking at the 31st of January. 31st of January is an important date. Now, one payment is payment on account, right? Payment on account for this year. Next payment which we are making is a balancing payment. Now, balancing payment of the previous year. So on 31st of January basically, we are making two payments for income tax. One is payment balancing payment of the previous year and payment on account for this year. So we are making two payments. All right. Right then. So what is payment on account? It says relevant amount. What is the relevant amount? Previous tax year income tax plus class 4 NI less previous year tax at source and multiplied by 50%. That will be the payment on account. So you have to make two payments on account and the final balancing payment. What is the final balancing payment? A current year income tax plus current year class 4 NLCs plus current year CGT less less current year tax at source less both payments on account. Now it says current year CGT. Now, why it is including CGT, capital gains tax? We will study the capital gains tax later, but basically we make the payment of capital gains tax on 31st of January, right? So for capital gains tax purposes, we make the payment on 31st of January. That's why it has included the capital gains tax payment here as well, right? So for capital gains tax payment, we only have to make one payment on 31st of January. For income tax, we have to make three payments. Two payments on account, one balancing payment, right? Let's move to the next one. Interest on late paid tax. Interest is chargeable on late payment of both payment on account and balancing payment. And interest rate, as I said earlier as well, HMRC will charge 3%, whereas if you have overpaid, HMRC will give you just 0.5%. Now, penalties on late balancing payment of tax. What are the penalties on late payment of balancing tax? On late payment of balancing payment. Right. More than 30 days late, but within the 5 months after the due filing date, then the penalty is going to be 5%, and this penalty will increase by 5%. So next penalty is going to be 10%, and then after that 15%. Now, if you've been more than 5 months late, but less than a year, so 11 months late, then it is 10%. If it has been more than 11 months after the due date, then it is going to be 15%. Now, this is the information, as I said. I cannot just put it in your mind anyway, so you just have to learn it by reading again and again. I don't know how you do it, but you have to learn this information. Right? Now, on page number 58, it says penalties for errors. Now, it depends on how big your error is, and if you're trying to hide it or not, then the penalty will be more. Excuse me. There is a common penalty regime for errors in tax returns, including income tax, CGT, NICs, corporation tax, and VAT. Penalties range from 30% to 100% of the potential lost revenue. So potential lost revenue basically means whatever the amount of revenue HMRC has lost because of our error. Now their revenue means tax. So for ourselves it is tax, for them it is a revenue. So basically whatever is a potential lost revenue, so according to that, the penalty will be according to that. Maximum amount of penalty. The amount of penalty for error is based on the potential lost revenue to HMRC as a result of the error. The maximum penalty of the maximum amount of the penalty for error depends on the type of error. So if it has been careless, it is going to be 30% of the potential lost revenue. Deliberate, but you're not trying to hide it, it is going to be 70%. If you're doing it deliberately and you are concealing as well, you're hiding as well, then it is going to be 100% of the potential lost revenue. Now these are the penalties which you have to pay. However, you can pay minimized penalties if you can satisfy HMRC about few things. Now whenever you have done an error, whenever you have made an error, if HMRC asks you that have you made this error, if you tell them, it means that you are not trying to hide, right? Now another thing as well, you can tell HMRC without them asking you. If HMRC asks you, then you tell them that is something else. But if HMRC did not know about this error, you told them that I have done a mistake, but I am telling you now, that is called disclosure. You are telling HMRC. Now disclosure can be made in two different ways. One is a prompted disclosure and other one is an unprompted disclosure. Now unprompted disclosure is the one where HMRC did not know about your error, but you just tell them because you were honest. So you just tell HMRC that I have made this error and I am telling you now. I'm sorry for that. So this is called unprompted disclosure. When HMRC did not know about the error, you are being honest and you tell HMRC. That is unprompted disclosure. Now prompted disclosure is the one where HMRC suspects that you have done the error, and HMRC then asks you that have you done this error? You tell them, yes, we did this error. Now in this case, it is called prompted disclosure. HMRC suspected that you might have done this error. They asked you and then you tell them. That is prompted disclosure. Now I hope that you know the difference between them. Now unprompted disclosure is a good one, better one than this prompted one, because in unprompted HMRC will think you are honest. In prompted one, HMRC will think you are honest but not as honest as in the previous scenario, right? So the penalties will be accordingly. Now let's see on the next let's see the minimum amount of penalties as well. Right then, so just beneath that, if you can see a type of error, if it has been careless and it is unprompted disclosure. So the first scenario where HMRC did not know about the error but you tell them because you were honest, penalty is 0%. However, if it was prompted disclosure, the penalty will be more, 15%, and this penalty will increase to 50% and 30% depending on unprompted or prompted disclosure, right? So that's it for this chapter. We've finished this chapter, and next time we will see inheritance tax, which is a tax on mostly death, but sometimes you have to pay lifetime tax as well on inheritance, right? Thank you very much and goodbye.